Well, hello, everyone, and welcome to this week's edition of the Fat Pitch Podcast. I'm one of your hosts, Paul Borowski, Chief Distribution Officer of Sealy Investment Securities, and I'm joined by your other co-host, Clint Sorensen. Clint, you've got too many companies and too many titles for me to keep track of. For those of you who aren't familiar, every week we try to bring you an interview with leaders, luminaries, legends, and even some lunatics from across the investment spectrum. I like to say everything from cannabis to cold storage and everything in between. Clint, why don't you tell everybody a little bit more about the Fat Pitch? I think you like to quote Ted Williams and Warren Buffett in the same sentence. Then introduce our guest this week.
Absolutely. Thanks, Paul. Yeah, fat pitch investing is about trying to find those opportunities that we think present a good risk and reward balance. And we're going to interview people that have subject matter expertise in these areas. We're going to let them talk about what they think the fat pitch investments are. And hopefully it'll give you something to think about. Again, we're not guaranteeing anything, and we're not making investment advice. This is just opinions and good talking points on what our speakers and what our co-hosts sometimes think are fat pitch.
Well, Ted Williams knew how to wait for it. I think he saw it before it came out of the pitcher's hand. And then I think you forwarded me a quote from the legendary Warren Buffett, the Oracle of Omaha, who said exactly that. Wait, hopefully you see it, and that's when you take a big swing. So who's our guest this week?
Yeah, so we have Tom Holliday. So Tom Holliday is the founder of HIP Investments, and his focus is on niche investments, which is really great. So he's here to talk about a lot of things. We're going to talk about the commodity super cycle, the green transition. And Tom, I'm really excited to hear what you think are some fat pitch opportunities given that backdrop. And I hope we go deep. I hope we talk about decentralization. I hope we talk about deglobalization. I hope we talk about the new Fed regime. I hope we talk about a lot, but we only have a limited time.
Are we going to start drinking along the way? What is
we might start talking about suburban investments too. You never know.
There you go.
Well, Tom, I want to just start with you and say, hey, Tom, give us a brief overview. Tell us who you are. Tell the audience a little bit about your background. And I might dig deeper into some of those points before we talk about where you think the opportunities are today.
Well, listen, fellas, I appreciate you letting me be on your show, and hopefully I'll swing and not miss on some of these things. But I'm originally from down south. I'm from Memphis, Tennessee. I've been in the alts business now for, over 34 years. Kind of crazy to even think about right now. It's snuck up on me big time. But it's also been an amazing journey. I think we all fail to kind of really appreciate the journey and not think about kind of the what we've been through, because sometimes you're so busy dealing with the immediacy of whatever's going on at the time that sometimes you don't sit back and take a look at, wow, this has been a hell of a journey along the way. And the different market cycles I've just seen in my career are pretty crazy, but super informative. And hopefully those experiences, lead to better results and help me to really think about, new opportunities. So I'm very grateful that I've had this opportunity and super excited about what the next chapter kind of looks like.
Awesome. Well, Tom, thanks for coming. Well, tell us a little bit about your past and investment experience, some of the firms you've been with. I know you got started in commodities, and I'll go ahead and say you're one of the smartest people I've ever met in my life. So
that's a lot coming from you.
And other smart people have come from commodities as well, right? So I think it's I'm starting to see a trend there. So tell me a little bit about your experience in commodities, getting started, and walk me through some of your investment experience. You've had some big titles and big roles and done a lot. And so I think the audience would appreciate that.
Yeah, sure. So as you mentioned, I started my career in commodities. I'm from Memphis, and a lot of people, think Memphis is all about Elvis and rock and roll, but it's actually not. It is a big commodity hub. Obviously, it's the Mississippi Delta. It was the largest cash cotton market in the world, but the first grain sale to Russia was done out of Memphis, Tennessee in the early 1970s. I mean, it's been a big commodity hub for years. And, just curiosity got me in the business. My dad was a doctor, and I knew really nothing about financial markets, but it was curiosity that kind of led me to those and commodities in general, just because of Memphis's position in that market. And you'd watch TV as a kid and you'd see like the price of corn and beans and this and that. And I'm like, what does all that kind of mean? I mean, most people from the big cities don't see that, but if you live in a more rural markets,
yeah, that's a really good point. I grew up out
things.
east, and I moved to Omaha for part of my career, and suddenly it was all commodities, not equities. So I understand that.
Right. So, and then you live in the big cities, you're seeing stock prices and market levels, but you live away from the big cities and you start seeing the price of beans and corn and wheat and all this other kind of stuff that, like, what is that all about? And if you just get a little curious and pull on those threads, it kind of leads you down a rabbit hole that hopefully you can get out of one day. But that's what kind of led me into the business. And, to your point about, some of the great commodity people out there, like Paul Tudor Jones, started his career actually in the cotton business and trading commodities. And I think it's a great training ground because you learn really, I think, really three important lessons. Commodities are about fundamentals, supply and demand. And at the end of the day, every market, I think, is driven off of supply and demand, number one. So it's very fundamental. Number two is there's a big technical component of commodities as well, of positioning and what's driving prices and flows and things of that nature. And then lastly is leverage, which is probably the most important lesson you need to learn. When you trade futures, they've embedded leverage in the contract. And if you're a speculator in those markets, you really need to learn about the effects of leverage and how to manage risk really, really quickly, or else you're going to be taken out of the markets. So I think those are really, three great lessons that the commodity investing, teaches you. The other one that probably is one of the best lessons is on the credit side of things, and credit kind of underpins everything as well. But those three lessons in the commodity side, I think, were fantastic for me. They were hard lessons to learn along the way. The School of Hard Knocks definitely applied, but it actually has helped me throughout my career in terms of looking at other opportunities. So fast forward, I got to work for George Soros.
Wow.
In 2000. So here's this guy from Memphis who gets to go to New York, and
that was right after Druck, right? Were you with Druck, or did you overlap?
I pushed him out.
I think the tech wreck pushed him out, but yeah.
Well, that's actually, what happened was obviously I got there right after.
What years were you there? Yeah, what years were you there?
I was just there for a year, and it was in April of 2000, right after the tech wreck, and after George and Stan decided to break the relationship, and Stan went on his own and managed Duquesne Capital solely.
So you came April.
But,
right after the NASDAQ had a bloodletting of 50 odd %. Interesting time to join.
Yeah, I think it was down 25% that month, and they got they had a pretty significant drawdown that month, and I think that's what caused obviously the relationship to sever. But listen, they've both done fine after that.
No tears shed.
Don't have to worry about.
No tears shed there.
No. And more importantly, for me, what I realized was where there's volatility, there's opportunity. And what that presented for me, luckily, was an opportunity to work, closely or more closely with George and an investment committee that was kind of restructuring the firm and what they were doing, which was pretty fascinating, to be quite honest with you, because I got to see how he thinks a little bit more and how he thinks about risk and reward a little bit more, and interact with some other legendary investors that had been with him for years and see how they thought about investing in hedge funds and different strategies. So it was actually a great, very informative period of time for me. But I was, entrepreneurial and had this bug to kind of do something on my own. And there's another guy that I'd known from down south as well that had been living in New York for a while that we decided to launch a firm together called Titan Advisors. So I left Soros to launch Titan, and Titan was a fund of funds and a hedge fund allocator that did a lot of very, very interesting things. It's a firm I was at for 19 years and was super proud of the team and the things that we accomplished there. But, if you remember back in 2000, obviously technology was on fire. and people were pouring money into technology, and nobody ever thought it would go down. And then the bubble burst, and people really got hurt. In particular, institutions, endowments and foundations and pensions and folks like that. And our thesis at the time was people were going to want a more risk managed way to invest in markets, and obviously hedge funds we thought were going to be a big push for a lot of these institutional investors as they look to kind of repair the damage that the tech wreck had done. And at that time, I think there was about $800 billion in hedge funds in the marketplace at the time. So it really wasn't that large. It was predominantly by high net worth families. The savvier endowments and foundations were the bulk of the marketplace, as well as some smaller institutions. So we started the firm at a time we thought there was going to be a big push, and really capitalized on our expertise in these markets, our expertise in the hedge fund area, and the need and desire for these institutional investors to get into the space. However, we were a new firm, and we had to battle the new firm problems that everybody has. Why would you put money with Titan when you could put money with Goldman Sachs,
right,
and not take that reputational risk? So you had to think about how you did things differently and stay true to your style. And one thing that my partner and I loved were more trading oriented strategies, people that really had a great fundamental underpinning, but really were savvy in terms of how to manage the position and manage risk. And then secondarily, we loved the new manager hunger element. So this is a big thing for us, which is at that time you had obviously some behemoths in the business, but we wanted to find the guy that had been through, or the gal that had been through a couple of market cycles, and they were about to embark on their investing career in their own fund, and they knew that they had to be focused 1,000%. They knew they couldn't lose money. They knew they had to manage risk really, really, really well in order to attract capital. And we really wanted to harness that element in what we do and really be differentiated. So the other, large allocators that we were competing against, were going with all the top name people out there, and that's fine. That was their edge. But we wanted to go with the newer guys, the hungrier managers, the ones that were just up and coming. And, we were invested in some phenomenal managers that you read about today. Like, for instance, Steve Cohen and SAC Capital was one of our core allocations.
Yeah. Tell us some good lessons you learned during that whole period. Yeah. I would love to hear, what was the most profound lesson you learned, both at Soros and probably, if you can pinpoint one thing at Titan. I love the emerging manager aspect.
Yeah, Clint, you do love emerging managers. I hear Clint talk a lot about that. And I also agree with you in hiring individuals or firms. I look for people that have shrapnel wounds, not mortal wounds. Maybe they're self-inflicted. Sometimes self-inflicted is the most valuable lesson learned. Maybe they're inflicted by the market, but I agree with you. I look for that because the hunger's there. And then when there's nobody making an auto deposit into your account from a company every 2 weeks when it's on you, you better believe you count every dollar of overhead and every dollar of AUM. So I certainly agree with you. But has that always been a belief of yours to look for that emerging manager? And how do you sort them out?
Yeah,
how do you find them? How do you qualify them?
Well, I think that, being a trader, early on, where you've kind of taken risk and you've gotten beaten up and you kind of know some of the lessons. I think the real differentiation between us, for us at Titan and in general for me, has been, that, having some experience in the market, you ask different questions. No disrespect to consultants and other people that focus more on process. And process, by the way, is exceptionally important. You got to understand how, people, discover ideas, how creative they are, what's involved in terms of sourcing those things. But as important, or more importantly, in our opinion, was how do you structure the trade? How do you manage the trade? How do you risk manage the trade? Because at the end of the day, there's a big difference between being smart, making money, and bull market can make everybody look really, really smart. And what you want to do is find people that have that unique combination of skills, which is great fundamentals with great risk management, great trade construction, and great trading. So, what I learned at Soros is, and he's written about this, and I think you've probably even heard interviews from Stan Druckenmiller about this, is, when you have conviction, that big. When you have conviction of something and you feel like you've got something that the market doesn't have.
Fat pitch. Swing big.
Fat pitch.
If you see the fat pitch, swing big.
Provided that you know where your liquidity is.
Oh, you have an accent.
You know where your liquidity is. So the big thing for me in terms of lessons I've learned is I was always a big guy that was like, okay, understand process, but then understand risk and where your returns are coming from. And if you were an analyst at Titan, and if anybody of them watch this clip, God forbid they do, but if they do, what I'm about to say is going to resonate with all these guys because I hammered it home every single day. There are three sources of risk with almost every strategy: leverage, liquidity, or concentration. One or a combination of those is typically what's driving returns in a guy's portfolio. And it was my job to understand around their process what was the primary and the secondary risk they were taking around those three things. So with George Soros, what was great about him is he would go big, but he would knew that he had liquidity. If he wanted to get out, he's out and on to the next, and in order to reduce his risk to something. And that was really interesting with George. And at Titan, to your point, we were a big believer in the hedge fund business. That's a talent business. It's kind of like sports, to be quite honest. Is that long only investing, you'd have an index and you'd have a manager's dispersion around that index really be pretty tight. Mm-hmm. But in long short equity, the dispersion of returns in a year, on average, I haven't looked at the data in a while, it's probably about 40% from. Is
that first to fourth quartile?
Yeah, first to fourth, at least 40%. Now, why does that exist? It's because of the way they take and manage risk. So you've got guys that got to be really net long, you guys can be net short, you guys got to have variable net, you guys can be really concentrated, you can have sector focused funds. You can have all these ways that they can use the tools that are afforded hedge fund managers to take risk, and that leads to this dispersion. So you better be very clear about your understanding of not only their process, but how they construct a portfolio, and then how they manage risk when things go wrong. Because guess what? Things are always going to go wrong. So where is my risk? What is my expectation around that risk? And when you're looking at a new manager, I'm going to turn my light on again. Sorry about that. If I look at a new manager, for me, it's like, what in their experience, to your point, has led them to this time in their life where they want to start a fund? Have they lived through a couple of cycles where they've probably been beat up a little bit, hopefully not too bad, nothing mortal, which has gotten to this point. And now what does the market environment look like relative to their skill set that I think will lead to future success? So I didn't care where somebody was. Timbuktu, if I heard of somebody that I thought was interesting, I'm getting on a plane or I'm having a phone call and I'm going to go meet with them because it was about the hunt. It was about the hunt to find the undiscovered manager. And another one of my favorite books is Moneyball, because
so good.
It's not about the guy that's expected to win, the guy that's got the perfect body type, the perfect resume, the perfect everything. It's about the guy that doesn't have that, that's got the passion and the desire to win that drives him, that I want to know. That's the person I want to find. And because, most other people are going to forget about that person because they don't fit the image. I want to find the guy with the weird release that nobody's going to look at because they don't think he can succeed in the pros.
So a question,
but boy, he's got a desire.
So a point and then a question for you. One is, I think we could all safely guess that Michael Lewis, who wrote Moneyball, is probably off writing a story about crypto right now, right? And SBF. He did high frequency trading. He's hit them all. He did the Big Short. That would be
I think he already had an interview with him.
I think he got the closed interview. He's going to write the best of it. Every book's on my shelf.
No doubt.
So are you continuing that work right now at HIP? Are you finding those undiscovered gems?
Let me jump in. I want to say one important thing too, as it relates to the fat pitch, right? And you mentioned something that I don't want to gloss over: the importance of managing risk, the position, the liquidity, the things you mentioned. Managing that risk is super important, even in a fat pitch, right? So you said that George always knew where the liquidity was. So it's a fat pitch. He's going to take a big swing. And so for our listeners out there, remember, just because it's a fat pitch doesn't mean you throw caution to the the wind and forget your risk management principles. You always have to manage risk. You're going to be wrong, know what to do when you're wrong, and have those decisions defined before you take a swing.
Yeah, because if you go 0 for 4 in the game, you might get sent out of the minors. You do that too many nights in a row. And I agree with you said leverage, liquidity, and concentration. I wrote it down because I think it does come with a little maturity or experience, right? That's what we old guys tell everybody. But you look at different markets from tech to, golly, I remember when all the insurers had all the CMOs in their portfolios and the market dried up, remember? Once you have no liquidity in a market, you got no market.
Well, liquidity rules everything at the end of the day. And if you take the two that you can't take at the same time, is leverage and illiquidity. That's usually a game over event. So really trying to pull on those threads is really, really important.
Yeah, I appreciate you bringing that up. That's what we call a GTZ moment, go to zero.
Yeah, exactly. All right, sorry, Paul, I didn't want to interrupt, but I just thought that was super important.
Yeah,
let's jump into the fat pitch now.
Yeah, tell us what you think are the fat pitch opportunities today from your vantage point.
You guys asked this a little while ago. I started my career in commodities, and it's hard to kind of get it out of your system at the end of the day. I'm always curious and looking at those markets. And, starting about 4 or 5 years ago, I started learning a lot more about the carbon allowance market or the carbon credit market, which are these markets that really underpin the move to renewable energy. They put a price on pollution, in essence. And they regulate entities that emit things and force them then to be a part of these regulated programs. And the dirty little secret about those programs is that they're set up to be in structural short supply as they meet to their goals in the day. So they have fewer allowances available than what's needed, all else being equal, because they want to force the regulated entity to change their behavior. And the only way you do that, obviously, is by it costing you a lot of money, and therefore you've got to change because you have to buy these credits. And so as a commodity guy, if you ever saw something in structural short supply, you're like, I want to own as much of that as I can get, right? And provided you understand, what could create some bumps along the way. And then as I kind of pulled on that thread a little bit more, I'm like, I need to learn a little bit more about this whole renewable energy movement that's out there. And, as you start to look at that and you're like, okay, you look at wind, and you look at solar, and you look at electric vehicles and batteries, and then the grid, it becomes pretty quickly apparent that all of those things need electricity metals: copper, aluminum, nickel, zinc. And if you want to throw in things like cobalt and lithium and the rare earth metals, those are at the tip of the spear. You can't get around using those things because the electrification of everything goes through those metals. So then you go, okay, so what's the supply of those things? And that's where we have a significant problem brewing in the marketplace. So, my view is, we have a commodity super cycle that we're entering in that is perhaps maybe going to dwarf the ones that we've seen in the past. So if you look over time, these commodity super cycles are really driven by an industrialization period or modernization period where, demand really outpaces supply, and supply is slow to respond to the demand period. And if you look at the industrialization of America in the 19th century, if you look at the rebuilding of Europe after World War II and Japan and Europe, if you look at China from 1999 through 2009, you had these huge commodity super cycles driven around these industrialization periods. I think the one we're about to embark on, I think, is the biggest of all those, and it basically has to do with the modernization of the energy system. And guys, it's hard to fathom what that means. There are three main things in life: water, food, and energy. Okay, energy being one of these things. And if we're moving our energy system from one that was based on fossil fuels predominantly, or almost entirely, to now almost entirely on renewable energy, I mean, we have to make investments on the order of 120 to 150 trillion dollars was what they're estimating between now and 2050. And those investments, by the way, require metal. Electricity cannot happen without these important metals. And then the problem is that a mine takes, the IEA states this, by the way, about 16 years for a mine to come to market.
My goodness.
16 years.
And how much supply
right
do we
now,
have based on that demand? I mean, how undersupplied are we? I mean, $150 trillion is a lot. And I've read articles where it's like $6 trillion a year in some estimates in order to meet these goals. So you have this huge wall of demand. And you've talked about the short supply. Let's walk through an example. Give me an example of one of the metals, and let's talk about how short supply we are.
Well, I mean, let's just talk about like copper, for instance.
Perfect.
So copper is the most important kind of electricity metal in this whole exercise. And there are a few different scenarios that all these research firms kind of point to, which is kind of a moderate scenario and then an accelerated scenario. And the accelerated scenario has to do with our net zero goals by 2050, which is limiting the world's temperature increase to 1.5 degrees Celsius. Okay, so that's the most, significant one that we have to deal with. And right now, the estimates are by, I think it's by 2030 or 2035, that we'll have to produce more copper than we've ever produced in the world up until this point to meet the demand by 2035.
So think about what that means per year.
Can you speak up a little, Clint, or you might be a little far from the mic?
Yeah, I mean, think about what that means per year.
Yeah, it's massive.
Well, it's like, for instance, Glencore in their December investor presentation, they see between now and I think it was 2030, a cumulative deficit. So between now and 2030, a cumulative deficit of about 50 million tons in copper. 50 million tons, cumulative. Now, right now, we produce about 24 million tons of copper a year, about. And by the way, I'm talking about refined copper. And, back in 2004 through 2006, I think in 2004, 2005, we had about a 1.8 million ton cumulative deficit in those 2 years. And copper prices went from about $1, it was a little bit less than $1, to about almost $4 in 18 months to 2 years from a small deficit. And that deficit represented maybe about slightly less than 10% of production. This 50 million ton cumulative deficit would represent a much larger percentage of production by then. So you're talking about significant supply demand deficits that exist in these markets that are going to lead to much higher prices. But more importantly, as importantly, the price of copper today is not incentivizing new production. I mean, what you have to have in order to get new production from these miners is an incentive. And the incentive is price. And due to the huge CapEx that's required to create a mine in these really crazy places around the world where you have to deal with all sorts of other risks.
Yeah, so the geopolitical influences have to be ever shifting here too, and playing a major impact.
And particularly in a world where we're deglobalizing instead of we have one big group hug.
No,
the group hug is going away.
Now it's a group stiff arm.
Exactly. And resource nationalism, I think, may be at the center of that group hug. And when you have resource nationalism, like Panama right now is in a fight with a large mining company around, royalty streams and permitting and stuff like that. And, what it can do is you can nationalize a mine where now the company loses the asset because the country takes it over, which, once again, creates real risk if you want to invest in the commodity equity side of things, right? So, you got these resources in all these crazy places around the world. Well, what's the risk you lose the asset? Because the country goes rogue and takes what you have along the way is a huge risk as well. But what I know on the commodity by doing a pure play in the future side is you are truly just focused on the production, the supply of what's out there and the demand for that product, and not directly being associated with as a company would with the risk of something like a nationalization happening, but you're just dealing with the supply-demand dynamics of that every day in a liquid market where you can move your feet when you need to, going back to George Soros, which is
know where your liquidity
commodities
is.
are cyclical.
Yeah, exactly.
Yeah, commodities are cyclical. And although I think the tailwind is like this, supply and demand will have to balance along the way, and you'll get ahead of the market at some point, and you'll probably get a reprieve. You're going to have to deal with macro factors like recession, which destroy demand along the way, and you have to have people that recognize when the micro and the macro kind of collide with each other. And actually 2022 is a great example of that.
Yeah, that's what I was going to say. You had growth and inflation start to slow in the back half of the year, and it just smoked industrial metals. So a lot of these metals who have these baked in supply and demand imbalances long term, they really had a tough time and performed like they typically do during a growth and inflation slowing environment.
Yeah. So talking about that, Tom, I think we probably got about 5 minutes left in today's episode. If we talk about the threats right now to your investment thesis, what do you identify as, you're looking for a fastball and it's really a curveball that might slip out of that pitcher's hands?
Yeah, I think that the biggest one is just the macroeconomic environment. I mean, as you guys have talked a little bit about, we're in tricky times. I mean, like for instance, right now in the equity markets, the Fed has stated that they're raising rates, albeit they're got an eye on the market. They think deflation's coming back. The markets have ripped higher, but we're in an earnings recession. And if you look at a lot of the leading economic indicators, there is pain ahead. If you believe that those indicators have predicted some of these pain ahead, and you would think that would flow through into some of the commodities as well. So that's one thing. But in the interim, you've got China that just reopened, and we have basically about 2 to 4 days physical supply of commodities on these exchanges around the world. So we basically have none at a point in time that China's reopening. And Europe, by the way, is accelerating their move to renewable energy because of energy security needs in relation to Russia and needing a lot of this metal for what they're doing. And then obviously the Inflation Reduction Act in the United States and the amount of money that's been committed to and thrown at renewable energy here. So the demand on this renewable energy side is still very, very high, but you have, global economic concerns about recession, and maybe a lot of that stuff hadn't played out yet. And as you know, a lot of these metals are in everything, right? Copper is in real estate, it's in appliances, it's in everything. So if we do go into recession, you'll probably see some of that ebb and flow around that. But you have to, once again, manage those risks along the way and realize, when you're at maybe one of those tipping points where you can manage risk and look to reset and capture those opportunities. But all else being equal, if we're going to meet these net zero goals and these renewable energy plans that countries around the world have, metals are the bottleneck. And depending on the scenario, it either is challenging from a baseline to almost improbable in terms of the accelerated goals. And what has to happen in order to encourage new supply is prices have to go materially higher in order to get there.
That's so funny. So you're really painting the picture, and I'd love for your thoughts on this, just to either say yep or add some value to it. But you're really painting the picture, for a secular regime that is long-term price increases, right? So inflationary, because of all the supply and demand imbalances that you've laid out. And you also start to factor in that deglobalization, which I don't think people are really paying enough attention to, and what that means for just natural price increases. As you get resource nationalization, you get less efficiencies in the system, and you get the U.S. stopping to police the shipping routes, right? So you're painting that picture, but you're also painting the picture for a tough growth environment if you think about it too. Rising costs, right? That's gonna come from somewhere, and you think demographically. So you're really talking secular stagflation met with maybe some cyclical deflation. Am I off base here? Is that a good summary of really the macro backdrop to the thesis?
I think that's right. I think the playbook is the 1970s, guys. I think that the last 40 years is the hard thing in investors is going to be trying to shift their mindset from the last 40 years, declining interest rates, marked by, in particular, the last 10 years of near zero or zero interest rates or negative interest rates as the blow off of this whole cycle. And now we're in a period where commodity inflation and other inflationary pressures are going to be sticky because of lack of resources, significant underinvestment, and the supply response that can't happen quickly because these investments take too long to get the supply. And therefore, I think you're going to have waves. So as you know, Clint, you're a student of the markets. We had a move up from like 1968 to 72 in inflation. We had a reprieve. And then like 1976, we had a reprieve. And then we had a blow off in 80, 81. And I think, a lot of people want to feel like this is 76. I kind of think this is like 72. I think we're still in the first leg of this
Let's
thing.
not see the equity market for the entire decade, please. I mean, well, maybe it's good for a guy who camps out in the real estate world like I do.
But that is the point, though. That's the important thing, which is if you look at the equity market from 68 to 80, obviously it didn't really do anything, and commodities outperformed tremendously. Look at the equity market from 1999 through 2008, 9.
Yeah, it did nothing.
Same thing.
Lost 59%.
Flatline, and commodities were up.
Commodities were rocking. Yeah, no doubt.
Yeah.
We could have an entire another podcast with you and talk about water, too. You mentioned water early on. Oh, golly. I mean, there's an entire college curriculum there.
I completely agree. And I just think that, we're living in a world where, we are resource constrained. And Russia, by the way, has taken off about 10% of the world's resources. In general, they represent about 10% of the world's resources.
It's remarkable,
so
isn't it?
They're offline. And then you had supply constraints before that, which has made things much worse. So we've got issues. Man, we wouldn't even talk about, by the way, where all these things are primarily processed, which is mostly in China. And we have obviously geopolitical concerns in China. So production is in geopolitically risky places. Processing is in a geopolitically risky place. It's going to be.
This has been really enlightening for me. It's not an area. I just think in terms of what it costs to build a warehouse. That's how I think about commodities. And Clint and I had an argument leaving the Crescent Court Hotel here a couple months ago. It turned out he was right and I was wrong, because we were thinking about the Bass Brothers cornering one of the metals markets here. And one of us said silver, and one of us...
The silver market.
I said it was copper. I said it was copper. So when you started talking about copper...
It was silver.
Yeah, Clint was right. I was wrong. Tom, let us know... I want to thank you. This has been terrific for me. I know you and Clint have known each other a long time, but... where can people find you? Do you have Twitter? Do you have LinkedIn? Anything like that? And anything else you might want to share here?
Yeah, I'm on LinkedIn. I'm not on Twitter. The name of the firm is HIP Investments. Our website address is www.hip.investments. No.com. That messes everybody up.
Well, you're out of Nashville. He's got to be hip, right, Clint? He's in Nashville.
That's right.
Even though you started in Memphis, you and the rest of California and New York have all moved out there. And I still...
It's pretty amazing.
It is a remarkable growth story, that's for sure. Clint, any final words?
No, just thank you, Tom. And we'll have to have you out to come talk about some other niche investments. Maybe you're going to create a SPV for egg investments, because I've seen eggs are on a nice positive trend.
I looked at, so we had a snowstorm in Dallas. I don't know if you know, we get an ice storm every year between end of January, beginning of February. I mean, you can set your calendar by it. So we just had it. There were no eggs in my local Tom Thumb, not even, forget cage-free, fancy schmancy, not even the white ones that look like the eggs were being, chickens in a gulag in Siberia, nothing. When I finally went back the other day, I think the ones I bought were over $7.50 for a dozen.
Yeah. So once again, I mean, we could talk about agriculture, we could talk about metals, we could talk about oil, we could talk about just commodities. It's going to be an interesting, I think it's going to be an interesting 15 to 20 years.
What a great conversation to talk about commodities. My first exposure, you're right, as a guy in the city was watching Clarence Beeks and Trading Places with Eddie Murphy and Dan Aykroyd try to corner the orange juice future market for the brothers. I know you remember, Tom.
That's why I got into business because of that. I didn't want to say that originally.
I bet you he makes his hotel and restaurant reservations under Clarence Beeks, Clint. We're going to check that out. Listen, Tom, it has been a real pleasure this week. For everybody everybody who tuned in to this week's Fat Pitch podcast. On behalf of Clint and myself, we appreciate your listenership. Don't be afraid to share it with your friends. We love growing an audience out there, and don't be afraid to share us your ideas for future guests. Tom, thanks so much for joining us this week. Clint, as always, thanks for keeping me honest and entertaining. And we sure appreciate everybody being on this week. Thanks, guys.